So the next video in this technical short series is going to be a real quick summary on revenue all the way to unlevered free cash flow. There's a couple different ways to do this, so I would just recommend sticking to one and getting that version down cold. The way we're going to do is go straight to net operating profit after taxes and then make a few adjustments to actually get to your unlevered free cash flow. So let's start it off. You take revenue, you minus the cost of goods sold, then you subtract out the SG&A. That gets you to an earnings before interest and taxes. Once you have the EBIT, you go ahead and you multiply 1 minus the tax rate to get to your NOPAT, or net operating profit after taxes. So net operating profit after taxes does not have any interest expense because we did not subtract it out. So therefore, once you have your NOPAT, you can go ahead and start making your cash adjustments. So you're going to have to add in your depreciation and amortization expense because that's included either in your COGS or SG&A that we already subtracted out. You're now going to have to subtract any increase in net working capital. So keep in mind, there's a big difference. You're not just subtracting net working capital, you're subtracting only the increase in net working capital from one year to the next. And then lastly, you're going to subtract out any CapEx to go ahead and get to your unlevered free cash flow. So real quick, 10-second version is revenue minus COGS minus SG&A gets you your EBIT. You're gonna multiply your EBIT times 1 minus the tax rate. That gets you your net operating profit after taxes. And then you're going to subtract CapEx, add depreciation, and subtract any increase in net working capital to get you your unlevered free cash flow. Unlevered free cash flow is just your free cash flow that does not remove any interest expense. If you subtract out interest expense as well from your EBIT, that would get you your levered free cash flow.